Okay, folks, welcome to the inaugural SoFiE lecture. I'm Frank Diebold, and it's a great pleasure to introduce Rob Engle, who of course needs no introduction, but I will simply say that, for 50 years, really, half a century, Rob has been a leader, really, I think the leader in time series econometrics, volatility modeling, financial econometrics, climate econometrics, and all of that is embodied, I think, judging from the title in today's talk, certainly financial and climate aspects are embodied. So the question today is whether capital markets have forgotten about sustainability. So Rob, it's all yours. We look forward to the answer.
Yeah. It's an honor to be one of the inaugural SoFiE lecturers. But it's also great to be here for Eric, because Eric and I have a long history, and it's really one of the things I'm most proud of in my life. We spent a year when Eric was in New York organizing SoFiE. We got this idea, we talked to the journals, we talked to many of you, and then we had a conference. We invited many of you to our inaugural conference, and from there, it kind of has mushroomed into a very successful society, and we're very, very proud of it. I mean, we worked a lot with Haley Kelly, getting it going. And then Eric and I kept being creative and sort of thinking of what should this society do, and when should we have meetings, and where should they be, and what should we call it, and all this stuff. Kind of out of nowhere, this happened. So I want to really thank you, because you really did it, and very happy to help you. And on top of that, we've spent a lot of time enjoying food, wine, music, great conversations about econometrics, and we wrote some kind of cool papers, I think. So all great. So thank you, Eric. And so now I'm going to try to give my don't look that.
Yeah.
Look at this one. Okay,
Yeah.
thank you. So I'm going to try to squeeze a 45-minute presentation into 35. Long run risk is something bad that might happen. Doesn't necessarily happen, but it might happen, and it's in the future, it's in the long run. And this is what climate risk is about. Climate risk is about bad things, might be super bad things that have some probability of occurring in the distant future. Of course, we see evidence of them already, but the evidence we have is only just kind of a forecast of what could happen. And the key thing that we're paying attention to at the Volatility and Risk Institute is asset prices, because asset prices are forward-looking and they respond to the long-run risks in climate change. And so we're going to be interested in using asset prices as kind of a window into what's the market's view about the risks of climate change. So here's an example. This was actually the Washington Post this week. They had done a little study on sea level rise along the U.S. east and southern coast. Okay. I guess I better not look that direction while I'm talking. And they found that since 2010, that's just yesterday, right? Sea level has risen between 6 and 9 inches in most of these cities along the East Coast. That's amazing. And when you see, and this is not just storms, this is kind of regular tides. And here's a high tide in some, I think, Mobile, Alabama, which just flooded the highways. And these things are happening. And so I want to use this as a motivation for long-run risk and how to financial markets price it. And many of you have heard me talk about the luxury beachfront hotel that I want you to think about. Suppose you own this thing. How do you manage it when you know that it's going to be destroyed in some number of years? You're not quite sure how many, but probably you've got a while, but it's going to be gone. So it's going to be an example of a stranded asset. And it's going to have no value ultimately at that point. So what should you do? Well, the main thing you might decide is that you're not going to renovate this hotel. You're not going to upgrade the bathrooms or anything like that. And so if you reduce investment, then all the revenue becomes profit. It's not just net revenue. It's, revenue minus other costs, but you don't have any investment expense. So that's the first thing. The second thing is that you might end up finding that your neighbors are doing the same thing. And so there may be a reduction in the supply of this kind of beachfront hotelier. And so the price would be likely to go up. Investors in your hotel might say this isn't worth anything because it's going to be destroyed if you have shares of stock in your hotel. But that's not really true. Finance says the value of these assets is the present discounted value of future cash flows, and these are not zero. In fact, they might have gone up because you're not investing anymore. So, and they might have gone up because the supply is shrinking. So there are a lot of reasons why these cash flows could be actually fairly healthy and robust. It's just that they have or an uncertain lifetime where they'll expire. So in a stochastic world, you sort of know how you, in a deterministic world, you know kind of how you value these. In a stochastic world, you don't know where it is, but the value of the shares in this hotel will depend on two things at least, but the two state variables would be the termination point and the demand. And I'm going to call this model of behavior in the face of termination risk model. And I'm going to argue that it looks a lot like the fossil energy sector. And that's how it becomes a climate problem, or how also it becomes a climate problem. So there are a couple other things to notice. We think that insurance rates will probably rise dramatically for this hotel. And so this doesn't really solve the problem. It might mean that it gets so high that you self-insure, you don't continue your policy. It might be regulators tell the insurers they can't raise the rates that much and they stop issuing insurance. There are all these things that are happening with insurance industry, but they don't solve this problem for the hotel owner. It's not like he's going to get his replacement value unless he pays a very substantial premium every year. Secondly, these neighbors down the beach might not all reduce their supply at the same time. There's a little competition between them. And so there might be incentives to consolidate the ownership of these beachfront properties. This might happen by one buying another one or something like that, but you might expect them not to expand the supply, but to consolidate the ownership so they can internalize these costs and extract some monopoly rents. Another thing you might wonder is whether this cash flow, this new cash flow that's available to the hotel owner might be useful to invest in something, like maybe he should start building electric vehicles. This will take advantage, take a role when the hotel is gone. Well, investors are not going to be happy with that, I don't think, unless the hotel owner has some special comparative advantage in building electric vehicles, this is going to be worth less than if he just returns the cash flow to the investors. There's a story that I was told when we were in Chile, actually Atacama, where this picture, the opening picture was, is the cigarette industry facing termination risk decided to diversify. And private equity eventually came around and said, we're going to buy you up and break you apart because you're worth more in pieces than you are altogether. And I think that would probably be true for this hotel owner as well, that investors are not going to want you to diversify this. So is this really a plausible story for fossil energy companies? Again, Atacama in Chile is beautiful. Well, here's what we agreed to in the Paris Accord, and this is the International Energy Agency's picture of what's supposed to happen. You're supposed to see coal, natural gas, and oil demand dropping off to zero in 2050. And if you think this is really what's going to happen, you've got a plan for termination risk. If you think it's not going to happen, it doesn't mean that the risk is not there. There is a risk that it will happen. And so if you're the CEO of this fossil energy company, my view is you've got to take it seriously that we might actually get here. Now, as economists, we notice the peak is right here where we are. So, economists don't like to be at the turning point and saying, we don't know how it's going to turn, but so we're going to get to that in a moment. But basically, this picture kind of says termination risk certainly is a possibility for fossil energy companies. Of course, this is the other side of it. This is what's supposed to happen to renewable energy, and we're not so sure that's happening either. So what's the empirical evidence that investors and CEOs of fossil energy companies are taking this seriously? That's kind of the question. This is sort of a hypothetical. What would you expect to see in asset prices if this is true? Well, let's look at stock prices. Are stock prices for energy high or low? Well, relative to what? Well, relative to earnings. What's the price earnings ratio for energy companies? That's, in a way, almost a measure of how many years of earnings do you expect to get. Another thing you might be interested in is price to book ratios, because the book value of this hotel is what you build it for, more or less. And the book value of an energy company might be the value of its fossil reserves that it has and all the refining companies, refining capability. That all might be worth less today than it was when it was built. So you might expect price to book ratios to be low, as well as price earnings ratios. Okay, so here's a picture of what price earnings ratios look like for different sectors of the US last week. And you can see this is the PE ratio, and the energy is the lowest PE ratio across these broad sectors. Price to book ratio, it's low, but it's not the lowest at this moment, although at other times when I've looked at the same picture, it is the lowest. So both of these argue in favor of something like this. Investors see this termination risk as being a real thing. Earnings per share over the last 5 years went up 14%. They're predicted to go up 4% over the next 5 years. That's a big decline. So this is what analysts are saying. They are predicting growth here, not decline, but it's a lot lower than what they've seen coming in. If you look at different subsectors, you see coal, thermal coal has the lowest PE, it's 5, and if we think about it, that might be 5 years. But then the different kinds of oil and gas businesses have higher PEs. The highest one is actually uranium, where it looks sort of like Tesla or NVIDIA, where you think the future is extremely bright, and maybe that's true for uranium. So I would like to calculate implied termination dates from this price and earnings data. Because if we think things are changing over time, they're going to change over time, partly because demand changes and partly because the termination date changes. So I'm going to show you a way that I can do this now, but it's not a full story here. And I'm actually still doing this, and this is a kind of speculative thing. So if we're standing here at time t and the current earnings are this, and they're predicted to be rising, from the price, you might be able to tell when it's going to turn over and become zero, and the value of the stock price would go to zero. So the idea is, let's parameterize this as a quadratic. We're going to think about what we know about the quadratic. We know where it starts and maybe where it's pointed. And then we're going to use the price data to tell us when it's going to terminate by saying, once we get this curve, the present discounted value of earnings under this is equal to the current market price. So these are the assumptions. We have a quadratic function. The growth rate is our initial forecast of where it's going. The implied termination date is where it goes permanently negative. And then we use the stock price to tell us what the shape has got to be. So earnings at time t over earnings today is quadratic. The first term is obviously a 1. The growth rate is what I'm going to take the average over the last 5 years. And then phi is the only thing we don't know. So we can use phi. I'm doing a grid search. Phi tells you when the termination date is. And once you've got that termination date, you can calculate the present discounted value of earnings and adjust it until that's equal to the market price. Okay, so this gives us an estimate of phi, and there's kind of, let's see, I did this earlier, so here are the results for these sectors. Here's the PE, and here's the implied termination date for each of these sectors. I mean, this will change over time. It's a sort of state variable, and if we can figure out how to do it in a more general kind of way, which allows for times when earnings are negative and when they're actually currently declining, and figure out how this picture is supposed to look, then we'll put it on VLAB and we'll see what it says about these companies. Okay, so there's a little more we can say about this. We're talking about stock prices here. What about bond prices? We might expect to see this in bond prices. I mean, if the life expectancy of a whole company is 5 years, and they're trying to borrow a 20-year bond, I mean, what are the lenders thinking about this? They must require quite a spread in order to be able to think that's a good investment. So we're going to look both at the credit spreads of existing bonds and the pricing of new issues. So here is credit spread of existing bonds. The purple is oil and gas 10-year bonds. The orange is non-oil and gas. And what you see is that there's a consistent spread between the two, but that it's much bigger during the pandemic and much bigger in 2016. I'm not exactly sure why this is, but oil price earnings were low at that point. It was the end of the Obama administration, and the Clean Power Act was in force. The Supreme Court later declared it unconstitutional to tell electric utilities that they had to switch to renewable energy. But this might have been a time when it looked particularly, termination risk looked particularly short. And one of the points is to try to get this time series to look like that. And here is the same thing for 5-year speculative grade oil and gas. Compare the blue and the purple, and you see the same kind of picture. If you look at the offering rates between oil and gas in red and manufacturing in blue, you see that they crossed back here in about 2008, 2007, something like that, and that oil and gas mining is now offering higher spreads for new issues than manufacturing is. In addition, they're offering vastly more credit enhancements in these loans. So not only do they have to offer a wider spread, but they have to put in credit enhancements like, special funding arrangements or optionality or something like that, that the lenders value in order to get them to pay even the prices that we saw on the previous slide. So it's a little complicated to figure out exactly what that difference really means, but it just emphasizes the fact that the capital markets are also responding to this drawback. And then finally, we see some mergers in the oil sector. ExxonMobil has just bought Pioneer, Chevron bought Hess, Occidental bought Anadarko a few years ago. And you might say it looks like they're trying to expand. And that's the way the newspapers talk about it. But there's a seller in each case as well as a buyer. The seller is trying to get out of the business, and they are selling it at some price which is probably pretty depressed. And so this looks like the consolidation that I described for the beachfront hotel. And I think that's a reasonable interpretation of this. And none of the cases does this actually expand the supply of oil and gas. It's just changing the ownership. And because of economies of scale and the ability to restrict supply, it's pretty profitable. In fact, there are other things that could also be looked at in the same way, such as the Ukraine war, which can be interpreted as Russia recognizing that it faces termination risk in its oil and gas industry and wants to diversify in a way that I guess they think Ukraine would do for them. The Middle East, you certainly see them effectively, I think, diversifying by buying sports teams and entertainment and air travel and all these kinds of things. There's a lot of evidence that internationally this is happening. And part of the consequence of that is the Middle East is reducing supply. Russia is reducing supply. Prices of energy are going up. This is kind of the same story in a different context. So now we look at the data. Of course, this is an issue. The only piece of data on here that looks like termination risk is really happening is the quantity of coal is projected to fall somewhere down around this termination rate that we calculated from the stock prices. But oil and gas are continuing to rise. So how do we interpret that? Well, we interpret that we haven't figured out how to do this yet, but it doesn't mean termination isn't going to happen. Politically, economically, we've made commitments that it's not clear we're going to be able to carry out, but maybe we will. And I want to talk next about how those commitments look. What are the kinds of commitments that we might take? In other words, how can we get to net zero by 2050? What sort of policies would we have to put in place? Well, there are really 4 types of policies, and Paris Accord means you can use combinations of them and so forth. We could tax carbon emissions. This is economists' favorite answer. We could also subsidize renewable energy. we could regulate emissions, that is sort of prohibit them in different ways in different sectors. And then there's a fourth policy, which I'm calling hope. Sometimes people call it do nothing. Sometimes people call it business as usual. I'm going to call it hope, because we're going to hope that consumers, employees, investors, and corporations will voluntarily adopt greener behavior. Now, economists tend to be skeptical about this. Politicians are hopeful about it. But we don't really know whether that's going to be sufficient to turn this curve over the way we are trying to do. But it's a part of our policy, and it's been actually the main part of the US policy until relatively recently, since we didn't really bring ourselves to do any regulation or taxing or renewable energy. Actually, Quebec, interestingly, is part of the California emissions trading system. And so Quebec does have a carbon tax like California does. They're both pretty low, but could be rising. The fact is, the issue for many of these things is not what it is today, but what it's going to be in the future. And that brings us to the next question: how should we think about these policies in the long run? And EU is taxing carbon, US renewable energy. China is doing some regulation and a lot of public policy to subsidize renewable emissions. But all of us are relying on hope to make these more effective. Okay, so a new paper that I'm going to give you just a peek at is a paper with Viral Acharya and Olivier Wang called Committing to Decarbonize the Role of Large Firms, Common Ownership, and Governments. So what this paper does is it looks at a general equilibrium economy, which has an externality in emissions and an externality in green innovation. So it's costly to decarbonize your company, but the costs are less if more people are doing it. So the more decarbonization there is, the cheaper it gets to be. And this is partly because technologically we figured out. It's partly that the whole supply chain has to be available to make it work efficiently and so forth. So the green innovation externality motivates subsidizing innovation and subsidizing green growth. So in the standard model where you've got these two externalities, it takes two policies to reach a first best solution. And so you need a carbon tax and you need a renewable innovation subsidy. And in this paper, we kind of work out the example for that for a parametric kind of model. And obviously, or maybe not surprisingly, the strength of the innovation externality depends on what the social cost of carbon is, and the carbon tax is set equal to the social cost of carbon in this case. But if you only use one of these two policies, you can't achieve this optimum. There is a second best kind of thing you might do. And clearly, one of the interesting questions is, if there's insufficient innovation subsidy, what would the optimal carbon tax look like? And the answer is it's above the social cost of carbon, because it has to get more people to decarbonize, and that reduces the cost of decarbonization and makes more people do. So you get somewhere toward the first best solution, but not as much as. And if you have too low a carbon tax, then in general you would want to increase the subsidy for innovation. However, if the carbon tax is too low, that is, say it's zero, then there is no incentive to decarbonize at all. Nobody's going to do it no matter what the subsidy looks like, because it's still going to cost them something. So there is an important nonlinearity there, which is that if the carbon tax is low, nobody's going to decarbonize at all, even if there's a subsidy. But of course, the carbon tax might be low today, but high in the future. And that's kind of one of the key issues here, is that if you can't raise the carbon tax now and you do innovation subsidies, then do firms foresee that it will be high in the future and therefore decarbonize anyway? Well, a case that is in this paper is a game theory kind of solution where large firms have an incentive to decarbonize, even if the social cost of carbon is not so high, or the innovation subsidy is not so high. Why is that? Well, and this is called the Stackelberg lever, and probably some of you know lots more about it than I do. But in any case, the idea is that this large firm, by decarbonizing, lowers the cost of decarbonization. And if the cost of decarbonization is lower, more companies will do it. And therefore, the air will be cleaner. And as a consequence, the air will be cleaner. The social cost of the price that the government puts on carbon would not have to be as high. So you would have to pay less tax, as well as the other firms that have decarbonized. So the calculation is that this could be your benefit. One of the implications is governments might have an incentive to commit to high carbon prices in the future in order to speed this up and to make it more incentive for these large firms to do this. They might then find that we decarbonize too much, in which case they'd want to lower the price. And have they really committed to it, or can they change their minds? This is, time inconsistency argument that theorists love. I never really know whether I take it seriously or not, but I don't know whether we take any of these commitments seriously or not. That's part of my trouble with the literature. But in any case, there's an argument that there's something good that could happen under the hope category here. And what you see when you look at firms who've made net zero commitments is that the biggest firms commit first and most frequently. And that might be consistent with the Stackelberg argument. Okay. Let's see, I started it.
5 minutes, Rob?
5 minutes. Okay. So I want to talk about investors now, and this is going to be super quick. Let's suppose investors want to hedge climate risk. They want to reduce their exposure. They might put some hedge portfolio in part of their assets, which would be portfolios that would be overweighted firms which are prepared for climate change. They're not exposed to so much climate risk, and underweight firms which are highly exposed to climate risk. What do these portfolios look like? Well, we have one called stranded assets that I'm going to use, which basically shorts coal and fossil energy. We have others which are low emissions, green minus brown returns, which is sort of more focused on the renewable energy subsidies, fossil producer minus fossil user, which is designed to be responsive to this termination risk argument that says fossil energy companies actually might profit from this transition, at least in the short term. And then some statistical performance, which you've probably heard me talk about this, and how you pick a fund of funds based on climate news and so forth. And then we have a new physical risk portfolio, which I think I'm not going to have time to talk about, but it's basically a portfolio of property and casualty insurers who are writing a lot of insurance policies in states that have a whole lot of climate physical risk. And those companies, whenever these risks are realized, have stock performances which go down. And so this is an outcome of high physical risk. And if you want to hedge, you want to be, underweight those companies. So this is a paper with Heiyun Young, Sean Gay, and Zuran Zheng, and I'm going to just bang through it. Okay, so what can you do? It's a whole paper. I could give. Anyway, what can we do with these hedge portfolios? You wonder what on earth are they good for? Well, you could invest in them directly. You could invest in funds that are correlated with them. You could invest in stocks that are correlated with them. And you could use them to stress financial companies like banks to see if they are exposed to them. So all three of these are ways of saying, okay, once you've got these climate hedge portfolios that are climate sensitive, where else do we see evidence of climate risk? What are the climate betas for all these hedge portfolios? And I'm just going to be quick about it. This is stuff on VLab. These are tables that we update every day. You can look at them. They're publicly available. And it's got a lot to say about this validation step that Alan is talking about, because these models are designed on a sample which is now 5 years old, something like that. And we're updating not only over the training set or the out of sample set, but the it hasn't happened set. And that's another level of validation. So these are 10 out of 200 of them. We've got return, volatility, Sharpe ratios, correlation with climate news, CAP-M alpha, and the beta on the stranded asset and climate efficient factor mimicking portfolio. You can sort on any of them. This is sorted on the CAP-M alpha, but you can sort of see what these climate betas look like. We can also do this for individual stocks. And this is a question whether the stocks are actually green or whether they're greenwashing. Or maybe that's the last slide should be about greenwashing. But anyway, many of these sustainable funds that were on the previous slide don't seem to have a green credential in this way. So maybe they are just greenwashing. In any case, so if you look at the 600 firms who were in the S&P for all or part of the last 5 years, we regress their returns on common factors like the Fama-French factor, oil change, oil appreciation, 4 of these climate hedge portfolios. Test the hypothesis that the average beta is equal to 0. If the t-statistic of this is positive, you say it's green. If it's negative, you say it's brown, okay? Or you could do this just by using the first principle component of these hedge portfolios and just look at the t-statistic. So these are the 10 greenest countries in the S&P companies. This is the 10 brownest companies in the S&P by this kind of measure. The brown ones look pretty much like what we'd expect. These are the oil and gas conglomerates mostly. The green ones are sort of all over the place, and it actually matters whether you use the beta, the average beta, or the principal component beta, what you're going to get. But I think that's because the majority of the stocks in the S&P 500 don't emit for anything except maybe heat and a little bit of transportation or something. And they can decarbonize relatively easily if they need to when the price of carbon gets high. And therefore, you know, it doesn't matter so much how you rank them. We don't have very many companies in the S&P 500 that are explicitly renewable energy companies. Okay, how about these betas? Well, they change over time too. So if you do a rolling regression, you get betas over time. But what makes one company have a bigger beta than another one? Why are the climate betas different across companies? Why are they different across time? Well, we could think about the betas as being a panel of dependent variables, and we could regress those on characteristics of all these companies. So here's a regression where the characteristics are basically financial data, assets over liabilities, cash over assets, long-term debt, CapEx, book to market, earnings over the market, Z-score, and this is just doing them one at a time, and you see you get a lot of significance in these cross sections. If you do the same thing with ESG characteristics, which are another set of data that you might use to say which firms are the greenest and which ones are not, you see you get a couple things that are significant, but these four are all emissions certificates. They're total emissions, scope 1, scope 2, and scope 3. So, the stars kind of are really that. Here you see also an innovation score that seems to be significant. But really what we want is a multiple regression. So if you put them all in together and you do it with various assumptions on fixed effects, industry or firm or year fixed effects, you get this sort of table. And you see book to market as a key variable, which is picking out the energy sector. It's negative, so it's a brown indicator for the market as a whole. If you look at the where's the innovation score? That's down here. That's positive here. It doesn't seem to survive the dummy variables. Mostly, ESG data doesn't show up in this table, but total emissions does. And you see it really has a negative coefficient. So the market seems to value total emissions as a variable, but that's the main thing that comes out of the ESG metric that we have seen so far. This is preliminary. It could change. There might be other information that's in there. The final thing is measuring climate risk of financial institutions. So doing the same thing. Okay, that looks like okay. So we can do the same thing for banks. And you'll get climate betas like this for JP Morgan, climate betas like this for Lincoln National, which is a property and casualty insurer. And this probably suggests that they have brown assets on their asset side of their book. The physical risk would be primarily on the liability side of the book, and that's one of the things that we're going to do with this physical risk measure. Allstate's property and casualty insurer, and doesn't seem to have evidence of the pandemic risk here the way we do, the way most of the banks and other insurers do. There is something here. I don't know what that interpretation of that is. And for the U.S. as a whole, you see a big peak where the pandemic is, which is an example of what happens if you decarbonize really fast, and it does expose the banks. You get another peak here, which is kind of interesting to think about. If you look at the same thing for the whole world, you see the pandemic is really here, but it doesn't really drop off. And this is in large measure because China has been continually increasing its undercapitalization of the banks, and they're so undercapitalized that actually the climate beta isn't really what's doing it. They're just undercapitalized already. So you do wonder whether China's due for a banking crisis, but so far, the fact that they're state-owned and the state has a lot of resources has prevented that. So in conclusion, and I have to show these pictures because everybody now expects them. This is 3 of my grandsons wondering whether the climate's going to be nice to them when they've grown up, or whether this lake is going to become very turbulent and forbidding. And so what kind of world will they inherit? And if we can tell them that we've got it solved, they'll be very happy. So, thank you.